Joining us to discuss is Jason Draho, head of America's asset allocation at UBS Global Wealth Management. So how big of a shift is this for you guys at UBS as the world's largest wealth manager, telling people to go underweight on equities?
I would say this is a modest shift. We've gone from kind of a modest overweight in equities relative to our benchmark from a week ago to now just a modest underweight. So I wouldn't say we've gone bearish. We've gone a little more cautious just because these trade tensions have continued to escalate beyond what we thought was kind of realistic to expect about a month ago. And then you look at the global growth data, it continues to show some weakness. So at least in the near term, there's just enough sort of uncertainties where we feel like it's kind of prudent to dial back risk-taking overall in the near term. But on a long-term basis, I think the fundamental outlook hasn't changed that much. So we're still trying to tell clients to stay invested in equities. This is not a signal to kind of sell equities, go into cash.
Where does the money go into then that you're selling out of in what you've readjusted? Into bonds at these levels?
Most of the shift has gone from essentially out of equities into bonds. I know there's the debate about kind of the relative valuations, the relative yields. The thing about bonds is that they have two attractive properties right now. If you look at the yield as a measure of its attractiveness, that's understating its total return. So just take the 30-year Treasury bond. Over the past month, if you'd bought the 30-year in kind of late July when it was yielding like 2.5%, its total return in the past month is around 12%. That's a pretty attractive return when equities were down about 4%. The other thing is that if you look at the correlation between how bonds have performed and equities have performed, it's been very negatively correlated. So bonds have been rallying when equity is selling off. From a diversification perspective, that's kind of ideal. So even though the yield is lower, now we've seen the 30-year versus the dividend yield on the S&P 500, from a portfolio perspective, bonds actually look pretty attractive, at least as a more kind of cautious play for the next kind of 3 to 6 months.
Hi, Jason. This is Josh Brown. So as a wealth manager, we get this question from savvier clients, and I'd love to hear your take on it. What do you say to people who say most of the reason to own bonds at this point is really for ballast or dry powder, so that if there's a negative event in stocks, you have somewhere to draw liquidity so you can buy more stocks at that moment or do a rebalance at a regular interval? What do you say to the people who say that with yields where they are and the crowding, quite frankly, into bonds of almost every duration and yield, that protective feature of bonds will not be there, specifically if the reason there's a negative market event is centered around the bond market, like having our credit rating slashed or some sort of a fixed income blow up somewhere else in the world? Like, are bonds going to protect us the way they have historically in the context of an asset allocation for a regular investor? What's your answer to that?
I think they will. Now, we have to differentiate between what would be very safe bonds. I think U.S. Treasuries being kind of the safest
Sovereign
out there.
bonds, Treasuries, right.
So, exactly. Credit, anything that's kind of credit-related, that's where there could be some potential stress. We know there's less liquidity in those markets. You're taking credit risk, so if you get an environment that could be bad for growth, those spreads are going to widen. So really what we're suggesting is certainly going to safer government bonds. It would really take something kind of truly cataclysmic for those yields to rise in that kind of scenario. Nothing that we see, at least in the near-term horizon, would suggest that. And even with yields low, it doesn't take much, given the long duration of these bonds, to actually still get a pretty good return to at least offset some of the equity risk. And if things do improve, and we don't think this is the end of the cycle, we don't think a recession is going to happen in the next 12 to 18 months, when things get better, if the trade, there's some sort of truce on that, growth data gets better, then we look to kind of reallocate back into equities because the long-term valuation relative to bonds is more attractive.
Within equities, it looks like you're somewhat defensive. You like consumer staples, but you also like consumer discretionary and communication services, which would suggest the non-recession call.
That's right. So we were, say, a little risk on in the sector allocation, a little more pro-cyclical. What we've done is kind of dialed that back to more balanced, slightly more defensive position from a sector perspective. And the overweights that we have, consumer staples, consumer discretionary, comm services, those all play to the U.S. consumer. And if we look at the U.S. economy, the strength right now is the U.S. consumer, it's the job market. So we want to be positioned to where there's strength. The sectors that we're underweighting right now, energies, industrials, and tech, they're more tied to the global economic cycle. That's where there's weakness. We're seeing it outside of the U.S. more so than in the U.S. So we'd rather take in kind of position where we think there's kind of stronger outlook for the consumer versus the potential further weakness in the global cycle.
Jason, outside of the U.S., is there any country or region in terms of equities where you're significantly overweight?
There's a couple of countries we like within emerging markets. Brazil is one of them. It's a very kind of a much kind of idiosyncratic story based on initially sort of the pension reform, that legislation that's been passed, but other signs of structural reform that should help kind of over the long term kind of lift the growth. And so that's one we like. And also we still like China within emerging markets. We think they're going to continue to do stimulus incrementally to offset the negative headwinds from tariffs. But the stimulus that they've done thus far has really been more beneficial to the domestic economy. It hasn't had the spillover effects globally. So if China keeps doing it, that's good for the Chinese economy, perhaps Chinese stocks, but maybe less beneficial to other parts of our emerging markets. So those are two regions that we like.
Jason Draho, thanks for joining us.